Well, hello, everyone, and welcome to our WISE program today from beginner to boss. We have an incredible program. We're thrilled to have Veronica Dagher and Jean Chatzky with us. But before we get started, just a couple of minutes about WISE. I'm Angela Daly, WISE CEO. In 1997, a small but very determined group of women met in Orange County to put on an investment conference for women. They had no idea what to expect and were overwhelmed when more than 500 signed up and they knew they were onto something. Fast forward more than 25 years later, and WISE has pivoted, grown, expanded its footprint nationwide, but remains true to its original mission of financial empowerment, economic empowerment for females of all ages and all backgrounds. We believe if you manage your money better, you're going to have more opportunities, more options in life, and very importantly, financial security. WISE works through organizations such as Girl Scouts, Girls Inc., and universities, and every year we reach thousands with this message. Today's program is part of our groundbreaking Tearing Down the Pink Wall series, which gathers the best and the brightest to both inspire us and educate us, all under the mantra, she can be what she can see. We have two fabulous role models with us today, Jean Chatzky and Veronica Dagher, who both share with a passion our mission of financial empowerment for women. Jean Chatzky is one of the nation's most respected and admired and listened to financial gurus. She has quite the resume. She was the financial editor on NBC's Today Show for more than 25 years and now heads up her own multimedia company, HerMoney.com. She's also an award-winning journalist and an author. But what's not on her resume is the fact that she has an uncanny ability to take financial topics and not only simplify them, but make them interesting and even fun. Investing is not rocket science, but we do need someone to explain it to us in plain English. And that's what Jean does absolutely brilliantly. So I urge you all, when this webinar is over, to go to her website, HerMoney.com, and sign up for both her newsletter, which is fabulous, and InvestingFixx for 1 month free. So now for our moderator, Veronica Dagher. Veronica is an award-winning journalist, personal finance reporter at the Wall Street Journal, the newspaper of record in finance. She's also a regular on Fox Business News and has her own podcast series, The Secrets of Wealthy Women. Now, I've known Veronica for many years, and she's a special person, a special friend. But what I didn't know until recently was how personal this whole mission of financial empowerment for women is. Her father passed away prematurely, leaving her mother with 2 young children and grappling to get her arms around personal finance. Their own finances. So she impressed on Veronica at an early age the importance of being able to manage your money, know where your money is, know where you're invested in, and know what you owe. So her experiences, Veronica's experiences, perfectly dovetail with our WISE mission, getting control of your finances one step at a time, which is a perfect setup to begin our webinar. We need more Veronicas and Jean Chatzkys in our lives. So put your questions in the Q&A box, not the chat box. We're going to take them at the end. And as with all of our webinars, it's for informational purposes only. Don't make any changes until you consult with your trusted advisors. So with that, over to you, Veronica and Jean.
Wow, what an intro. Thank you so much, Angela. And thank you, WISE, for having us. We're so excited to be here. This is going to be an amazing event. I can tell already. I'm sure we're going to have some great audience questions. So I want to make sure people know that at the end, we're going to take your questions. So please be putting them in the chat box as we go along, and we're going to get to them. And it is my great pleasure to chat with Jean Chatzky today. She is a woman who, as you know, needs no introduction. Jean, you are just a wealth of money savvy, and your reputation just precedes you. And I'm sure everyone on here knows who you are, but I would just love to hear more from you about your personal money story, especially when it comes to women and money, because that is something that you are just so passionate about. Is there a specific moment or incident that got you focused on this area?
Well, absolutely. Happy to tell you the story. Always really good to see you, Veronica, even when we're not in the same room. And Angela, thank you so much for having me. Thank you for the introduction to Wise. I'm inspired just listening to your origin story. So I'm excited to have this conversation today. Boy, pointing to one moment, Veronica, that's a little bit hard, but if I had to do it, I would point to the year that I turned 40. The year I turned 40 is the year my father died, which I now know that you can absolutely relate to. It's the year I got divorced. It's the year that I got fired, and it's the year that I turned 40. So,
Oh
like,
my God.
all of those things happened at one point.
Yeah.
And I was fortunate enough to have a career that was already pretty involved in the gig economy. I had a lot of jobs. In addition to the Money magazine job that I lost, I was already working for the Today Show and working for a number of other people. But that whole year-long experience caused me to really focus on my own money once again, but also on money for women. I didn't want any woman to find themselves in any of those scenarios that I found myself in and not be able to right their own ship. And so that was when I started really looking at women and money. It was when I started thinking about HerMoney as a podcast and as a company, although it took a little while for it to actually materialize. And that's the work that we continue to do a number of years later.
Wow, what an incredible story. And what a survivor, what a strong woman you must be to have gone through all that and come out so beautifully on the other side. I'm just curious, how did you find that strength during that time? And I would imagine there was a lot of financial pressure happening.
Well, there was a lot of financial pressure because I was an equal earner with my ex-husband, which meant that I was on the hook for college. I was on the hook for my own retirement. I wanted to buy a house because I was the one who was going to be moving, and I wanted to be very sure that my kids, when they were with me, would be absolutely as comfortable and as at home as they were when they were with their dad. And I rallied a team. I mean, I got some really, really good advice. I had a good financial planner, I had a good accountant, I had a good therapist, and I had really good friends. And I needed every single one of them during that year. And I think you can probably attest to this. People look at people like me and like you, and they think that we have all the answers. And in reality, what I think I'm really good at is asking the questions.
Mhm.
Being a personal finance reporter has allowed me for 35 years to get the smartest people on the planet on the phone and
Mhm.
ask them my questions about credit cards and mortgages and investing, and then ask the questions again when I didn't understand the answer until it started to actually sink in.
Mhm.
These are not topics that we're necessarily born knowing how to understand. And even when we are, the industry makes it their job to try to confuse us time and
Mhm.
time again. And so knowing that it's okay to dig in and ask your questions and get the information that you need until you understand it is what I think it's all about.
Absolutely. Yes. Asking the questions, knowing that there's no stupid questions. And if someone tells you you have a stupid question, that's not the case. And also, I know from my own experience, having made a lot of the mistakes, I've done it all.
Uh-huh.
Yep, yep. So women and money, I'm wondering, and it's hard to generalize, especially when it comes to investing, but I'm wondering, is there some common threads you've seen among women, when it comes to money and investing, women and investing? like I said, it's such a broad and diverse group, but are there common notes?
There are, and I think there are notes that are important for us to pay attention to because they tend to run along a theme. I wrote a book a few years back called Women with Money. You and I have talked about that before, but in doing my research for that book, one of the things that I did off the bat was go out and ask a lot of women what they wanted from their money. Just a very open-ended question. And from women at all different points of life, I heard a lot of the same themes. We want safety, we want security, we want stability, we want savings, actual cash in the bank. And as I followed those breadcrumbs, I started to see the different ways that that sort of information would show up. Fidelity did a study at one point where they pointed to the fact that women had a lot of excess money sitting in our checking accounts that we should have been investing. It wasn't our emergency cushion. It wasn't money that was tied to a particular goal. We just felt safer having it sit in cash than we did investing it. And this was at a point when interest rates were a lot lower than they are right now. So we were losing money after taxes and inflation on that money. I saw this desire for safety and security show up in things like the fact that we don't just want homes, we want homes with paid off mortgages. And we don't just want cars, we want cars with all the safety features, with every possible airbag and all the backup cameras. And I've seen it in the research that we conducted at HerMoney. Just recently, we fielded a survey that we call our State of Women 2023. It was 2023. We did it in 2022. We'll do it again this year. And we asked about what financial wellness is to people. We actually surveyed both men and women in this survey. This year we fielded it with the folks at Principal Financial. And what we found was that for women, financial wellness feels like financial peace much more than it does for men. It's the lack of stress. It's the lack of anxiety. And I think that colors many of our interactions with money.
Would you, and it seems like you're definitely getting at this, like in terms of some of the fears women have about investing. You said there's a need for safety. So what's the fear behind that? Is it loss?
Yeah, I think it is loss. It's the fear of losing money. It's the fear of getting the answer wrong. It's the fear of not knowing. When we look at women as investors, we see women are fantastic investors. There have been a number of studies that point to the fact that women are better investors than men in many cases, and in part because we trade less frequently. So we get in, we do our homework, we figure out what's going to work, we buy it, we stick with it. The problem that we have, and I think this is where that fear element comes in, is that we tend to be late to the party. We tend to hold off before we get in because we want to know that the answer is the correct answer. And although there are some types of personal finance where I can give you an answer and I can pretty much guarantee that it's going to be the right answer, which is the best mileage credit card. I can't do that with investing because it's not, it doesn't work that way. And so we have to get ourselves to the point where we're more satisfied with the good enough, where we know that we've got answers that are good enough on a historical basis that will carry us through, but not allow ourselves to be held back from digging in, whether that is digging in via our retirement accounts at work, or if we can do more than that because we have additional money in discretionary brokerage accounts.
I think part of changing a mindset or getting rid of a fear is understanding where it comes from. Do you have a sense of where some of these Sounds like very specific fears that may be specific to women, some women come from.
I think we're socialized this way still to a degree.
Mhm.
A lot of us were raised by mothers who believed that you didn't talk about money. And so as a result, maybe we were a little more reticent to talk about money. When something seems like you shouldn't be talking about it, it is a little more scary, perhaps, than it used to be. Also, the division of labor in our households has often meant that women do the cash management and the shopping and the budgeting. Women are responsible typically for about 85% of all purchases. Men have often taken on the investing. And when you aren't involved in something, when you're not doing something, then it seems a little more frightening. Now, we're starting to see that change with younger women, which is amazing. And I think one of the big reasons that we're starting to see it change is auto enrollment into retirement plans, which the Secure Act has just basically said is going to happen across the board, means that you're doing it whether you chose to do it or not. And once you've got a stake in the game, you're more likely to pay attention to it. You're more likely to acknowledge that you, in fact, are doing it pretty well. But this is why I'm so enamored with our InvestingFixx program. Angela talked about our InvestingFixx program. It's our investment club for women. My friend Karen Feinerman, who is on CNBC, she's a professional investor. She and I are teaching investing every other Monday night on Zoom to a group of hundreds of women. We're presenting stocks and talking about things like asset allocation and diversification and answering questions in a very low risk sort of a setting where people feel free to ask all their questions, where they don't have to buy the investments, where we're building a portfolio together and everybody votes on what we, the club, buy for our portfolio, which is beating the market, by the way. And um, and it's just bringing people along in a way where we don't feel like there's that much on the line.
For those of you who don't know Karen, Karen is wonderful too. So that sounds like a really fun club. I might look into that myself, Jean.
Come along.
Yes, yes. And I just want to hit on this negative money messages a little bit more. You know, we might say to ourselves, we're not smart enough to be a good investor. How do we get over some of that messaging, which we may not even realize we're saying for ourselves? It's just kind of programmed inside of us, but it's preventing us from taking those next steps.
So the way I got over it was by just going with what I knew to be true historically. So historically, we know boring investing tends to be better investing. And by boring investing, I mean buy the indexes, keep your costs low, put money in every single time you get paid by dollar cost averaging through a retirement program, grab all the matching dollars, and then watch your accounts. And by watching your accounts through good markets and through bad markets, you see that over time the trend is up. Over time, even when we have a 2022, which was a disastrous year, the markets have come back. The markets are in fact up. And I got to say, I was at my desk in 1987 for Black Monday, through the dot-com boom and bust in 2008. I've seen this a number of times. It comes back. And the lesson that you learn is that if you just do it, you will learn that you can do it. Which I know is hard to wrap your arms around if you're not doing it today. But just dipping a toe in the water and showing yourself that you actually can is, I think, the best way to convince yourself that you can do more.
Hmm. Mm. So we have investors of all ages and stages on this call, which is so great. So I'd love to chat a little bit more about getting started as we're talking about now. So first of all, again, a little bit with the mindset. Someone might say, well, I'm saving. I put money in a savings account. Why do I have to invest anyway? Why is this so important?
Because right now, if you put money into a plain vanilla savings account at a bank, it's earning you 0.3%, 0.3%, maybe 0.4%. But at that rate, you're losing purchasing power after taxes and inflation. If you put money into a high yield savings account, and I've been following your coverage, Veronica, at the Wall Street Journal of about how these high yield savings accounts are really, you got to watch them because they're not all paying what we think they're paying. But even if you've got the best of the high yield savings accounts, you're putting your money away and you're going to earn 5% maybe. And as the Federal Reserve starts to lower interest rates, which we think is coming down the pike sometime, perhaps in 2024, if not 2025, those returns are going to start to go down once again. Historically, if you put money into the stock market, into an S&P 500 index fund, you're going to earn 10%, you know, and even if we don't keep up with those historical returns, because we are coming off a very strong period of a couple of decades of bull market returns, even if that doesn't continue, if you go all the way back to the crash of it in the 20s, the Great Depression, you're going to earn more than 8%. That is how we stay ahead of taxes and inflation. And that is how we grow long-lasting wealth, by putting our money to work and spending a lot of time in the market and not giving into our emotions when the markets get volatile or scary, and pulling our money out. And the reason that it's more important for women is because we are going to live a really long time. When we look at longevity trends, longevity over the last couple of decades has just gone up, and it's gone up particularly for women. And so not investing, I think, is actually a way to hold yourself back from being able to enjoy those last couple of decades the way that you would hope to.
It's reframing a little bit that not investing is risky.
Yes.
Not- what about, I remember when I started out my career, I don't know, I was making $30,000, like hardly making any money for living in New York City. And I remember saying to my mom, like, I can't afford to invest. I can barely, make my rent with a roommate. I don't have enough money. And she was like, you have to contribute to your 401k. You have to do it. And I did, listening to her. I'm wondering though, I'm sure so many people today might be feeling the same way. Like, I don't feel like I have enough money to invest. What do you say to them?
I say I get it. I mean, that $30,000, I got to say, sounds pretty good to me. My starting salary in New York in 1986 was $11,500. Um, and taking the subway back and forth to work, it was paying rent in Brooklyn. It was not easy to make ends meet. I got a second job at that point just to be able to afford to stay here. I would say try to do something. If you can't, if you look at these sorts of wages when you're young, when you're in your 20s, particularly if you are saddled with student loan debt, it can feel absolutely impossible to put money into your retirement plan at work. But you got to try to at least get yourself to a point where you're grabbing some of those matching dollars. And then every time you get a raise, nudge up your contribution a little bit. That's the easiest time to do it because you can put more into retirement without taking money out of what you're used to taking home. And this year, again, thanks to the Secure Act, employers now have the ability to match what you're putting toward student loan repayment in your 401k. So if you are using your resources to pay down or pay off your student loans, your employer can put its matching contributions in your retirement. So it gets away from that problem of young people not being able to contribute at all during those early years.
That's great. That's great. So it can feel overwhelming to start. So if you had to give us one or two steps that we could take right after this event to start investing, what would you tell us?
Well, if you're not in your company's retirement plan, but you have one, call HR and just ask them about the steps to get enrolled. If you don't have one, and there are a lot of people who work for small companies or work for themselves, open a Roth IRA and figure out how much you can afford to kick in on a monthly basis. Maybe it's $50, maybe it's $100. I'm sorry that nobody's matching it for you. Do it anyway. Put that money into a total stock market index fund or an S&P 500 index fund and just call it a day. But let the money go in, let it continue to, let it start to grow for you. And then if you're interested in this picking of individual stocks, if you want to know why everybody's talking about NVIDIA, or if you want to understand, what's going on with Meta or with crypto ETFs, then our investing program might be interesting to you. Again, it's not like we're all pooling assets, but we are learning enough about these things that we bought NVIDIA when it was about half of what it is today. So
Right.
we get into the zeitgeist, we talk about it. We definitely have some picks that have not panned out so well. But I think it's interesting to learn about how companies function and if we should be investing with our values or if that's just a recipe for losing money. I think it's fascinating to learn these lessons just so you can talk about them because they're certainly in the papers every single day.
What's a mistake you've seen beginner investors make?
So we switch jobs a lot more frequently than we used to. People used to go to work for a company, they would stay there a really long time, not necessarily to retirement, but enough to allow the money in their retirement accounts to grow. We switch very quickly. And as a result, we have these small balances in our retirement accounts. And when we leave those jobs, sometimes the money just seems like it's not even worth rolling over. It's not worth rolling into the new plan. It's not worth rolling into an IRA. This was a biggie. And I did this when I left that first job. I had a 401k. I didn't get it. When I left that job, I got a check in the mail. I just went shopping. I was thrilled. And then I had to pay taxes on that check. So that was not a lot of fun. But if you make it a habit to raid these 401k accounts, these orphan 401k accounts, you're never going to have anything left for retirement. So try to make sure that you are rolling that balance over. Another mistake I would say is the not rebalancing your accounts once a year. As we were talking about earlier, the markets have been on a nice run. But what that means is that if you decided that maybe you wanted 60% of your investments in stocks, the markets have run up to a point where you've got maybe 70% of your assets in stocks, having done nothing different. just because of the way the markets have moved. And that means you're taking more risk than you initially decided that you wanted to take. So once a year, you can do it whenever you want. You can do it on your birthday. You can do it on the 4th of July. Once a year, go back in and rebalance your mix, bring it back into line with where you thought it should be. The folks at Vanguard have done some research and have said once a year is enough. You really don't have to do it more than that. You can decide that you're going to rebalance when your mix gets out of whack by a particular percentage. If you're 15% out of whack, if you're 10% out of whack, you can bring it back into line at that point. But once a year is usually sufficient. Or if you know enough about yourself to know that you are just not going to do that, and there are a lot of people who know that they're never going to do that, just put your money in a target date fund and let it do it for you.
Hmm. I want to remind everyone, we're already getting some questions in the Q&A. I would want to remind everyone to ask away, put some more questions in there, and we'll do our best to answer them at the end. So please keep thinking of what you'd like to ask us. Jean, one of the tricky things, and you had mentioned this before, is all the ups and downs in the stock market, whether it's 2008 or earlier times. It can be tricky to stay invested. What is your advice about tolerating that volatility?
Stop looking. I mean, I think there comes a point where you have to just take that screenshot of your portfolio and move it out of your line of sight. Don't don't go to cnbc.com every day. Don't look at it. Particularly if you know that you are likely to be susceptible to wanting to pull your money out. The other thing that really helps at times like this is having somebody to talk to, having somebody to sort of talk you down. A financial advisor in the loop can be particularly helpful at this point, but there are even robo advisors that can nudge you in the right direction. I was meeting just last week with the CEO of a firm called Betterment, which is one of the large robo advisors, and they've got nudges built into their platform where, if the markets start to fall and they see people trying to move money, they're going to ask them a question, not to tell them they can't do it because it's their money, but to get them to think twice. Ask a question about, hey, do you know if you do this, you're going to have some tax ramifications? Do you know that if you do this, you could be looking at a taxable loss or gain or whatever, just to try to slow people down in the moment. And that's what you want to do to yourself. You want to slow yourself down a little bit. It's a little like making an impulse purchase. As somebody who likes to shop, and I like to shop, I will put artificial constraints around myself so that I'm not buying more than I want to buy. I'll force myself to wait 24 hours before making a purchase. I'll leave things in my cart if I'm shopping online, just to think about them a little more and make sure that I don't already have 2 pairs of pants in my closet that look exactly like that, so I don't need them anyway.
Speaking of shopping, and often debt comes with that, credit card debt. How do we balance paying off with credit card debt with investing? What do we prioritize? How do we tackle which one we should handle first?
There are a couple of ways to look at this, and I actually like to look at it both ways. The first is to look at it by the numbers. When you're paying off any debt, the return on your money is equal to that interest rate. So if you're paying off a credit card at 30%, that's a 30% return on your money. That's a lot. If you're paying off a student loan at 6 or 7%, that's a decent return on your money, but it's not as high as 30%. If you're paying off a mortgage at 3%, that's not a very good return on your money, which is why a lot of people are holding on to these very, very low rate mortgages that they've got. Now you compare that to the return that you get on your money by investing. If you're getting matching dollars at 50 cents on the dollar, that's a 50% return on your money. That beats the 30% return that you get paying the credit card debt. So I try to stack it in my mind and look at, all right, where am I going to get the best numerical return on the money? But then you also have to look at it emotionally. When we look at what makes us anxious or stressed or unhappy about our money, it's debt. And credit card debt is at the very top of the list. So if you're carrying a lot of credit card debt, I may split the difference. I may just acknowledge, okay, I'm not going to get the very best numerical return that I possibly get, but I'm going to take some of my money and throw it against that credit card debt. And I'm going to take some of my money and grab those matching dollars until I get rid of that credit card debt. And then I'm going to put up a lot of barriers so I don't incur it again.
Great tips, great tips. What about if you're getting closer to retirement? What investing steps do you suggest?
So, interestingly, we just rolled out a pre-retirement class for InvestingFixx, which is our it's our cash management class. It's our spend less, save more, set some goals, and start moving in the direction of those goals class. And it's really to help you get some clarity around your money and figure out where it's going, what it's doing for you, and make sure that you're headed in the right direction. It's an 8-week course. And over the course of that 8 weeks, we're finding that people free up about $1,500, which is pretty substantial. That's an average, and they use that to save. They use it to pay off debt or to work toward another goal. We're in the middle of our first round of that class for pre-retirees, and we've structured it as a pre-retirement checkup. And the first step there is to figure out what your budget in retirement, what your spending in retirement is actually going to look like. People reach for these retirement goals. I need to have, well, you did the series, I need to have $1 million. I need to have $1.5 million. I need to have $2 million. But often those numbers are random. They heard that's what the number should be, and so that's what they're aiming for. But really, your number should be based on what it's going to take you to live the life that you have established for yourself for as long as you are estimating that you will live, which should be a really, really long time, again, for women. So we're helping people do that math to figure out, first of all, what their spending is going to look like. And then are they on track to accumulate enough money that it will throw off when combined with Social Security enough to cover that monthly nut for 30 years, if not more. And whether you go through that exercise with us or whether you go through that exercise with a financial advisor or whether you go through that exercise on your own, it's a necessary exercise. And it's really troubling to me that once people get into retirement, we know that many of them have never even tried to do it. And that means you're just retiring into a vacuum. And it causes people to make a lot of bad decisions, like tapping Social Security too early and pulling money from the wrong accounts on a tax basis when pulling it from some other place could mean that they've got a longer runway when it comes to making their money last. So I think this idea of a pre-retirement checkup around your 50s, some mid 50s, 10 years-ish before you retire is one thing that everybody ought to go through. We're launching another one of those classes specifically for pre-retirees in early April. So that'll be available, and we're going to keep running them because they're filling up, which is exciting for us. Another thing that you want to look at and is this Social Security question. People leave a lot of money on the table by tapping Social Security way too early, when in fact they should be letting their Social Security benefit grow into their late 60s, if not age 70. And even if that means pulling money out of retirement accounts because you're no longer working, that can be the smart move to make. You just have to run the numbers, and you have to do it with your spouse, because there's a lot of complications to see how it works for you if you have one. And if you're divorced, or if you're widowed, it's even more complicated. So there are a lot of levers that you want to pull on. And then the final thing I think to look at as you're heading toward retirement is the equity in your home, which is for many people the largest asset that they will have accumulated, and figuring out how they're going to use that and when they're going to use that. We know that about 70% of people tell us they want to live in their home forever. And that is great as long as it lasts. But only 1% of the housing stock in America is actually age friendly for people to retire in. So a lot of people are going to end up moving, and you want that decision to be yours. You want to be able to make it when you want to make it, and use the money that you have accumulated as equity to set you up as best it can for the rest of your life, whether that means staying in that home or not.
Speaking of retirement, I'm thinking of so many women who have taken career breaks, whether it's to raise kids or help elderly parents. How do you balance saving and investing for retirement when you are taking these breaks? What advice do you have for women in those scenarios?
It's such a good question. I'm zooming with you from Philly. We moved here to be closer to my mom, who's in her 80s. And I would not call myself a caregiver at this point, but I'm close enough so that if and when I need to be a caregiver, I am available to help. Being a caregiver is really costly in a lot of ways. Caregivers spend about an average of 7,000 out of their own pocket on care for the person that they're caring for each year. When you step out of the workforce to care for somebody else, you're not just losing your salary for that period of time. You're losing Social Security credits. You're losing your ability to put money into your own retirement accounts. You're taking a step back when it comes to seniority and networking, and all of those things can be really, really costly. So the first thing I would say to people who are thinking that they are heading into their caregiving years is to think about whether there are ways to keep a foothold in the workforce, to not step out entirely, and whether stepping out at all is the right decision, even if you're spending as much as you're earning on care for somebody else. If you stay in, you're not losing those other things. Now, there are a lot of people who want to step out, and I think that is great, as long as you have thought through all of these other decisions. But if you can make it easier for yourself to re-enter in some way, you're not going to be sorry about that.
Yeah, it can be so hard, and you want to help other people, but you also got to be able to help yourself and take care of yourself if needs be down the road. We have some audience questions that I would love for us to shift to for a bit. And this first one is an interesting one. And you had mentioned sustainability a little bit before. And so our audience member writes that they're conflicted about investing in any company that isn't thinking about long-term environmental impact. And they're wondering, is there a way to invest only in companies that are sustainable and green? And so I'm curious, I'm not asking, I don't know if you for stock picks specifically, but more, maybe you can speak more, or if you'd like to, you're free to do that. But overall, what should we be thinking about when we're investing in, ESG companies?
Yeah, I think we should understand it is a really complicated landscape. And I'm conflicted just like you are about investing in companies that I don't think are walking the right road toward a more sustainable future. But as I've dug into this topic, I've also learned that that the screens that we apply to try to sort out which companies are doing the right thing and which are not are flawed. And some companies can be doing great things when it comes to climate, but not such great things when it comes to taking care of their own workforce. So you have to be really specific when it comes to what you're looking for. If you and I if you sign up for InvestingFixx, you get a free month, but you also get access to our library. And I would say do that and go back and look at the class that I hosted with a woman named Janine Firpo, Firpo. All of our past classes live in our library. She took us through how to do these screens using tools that are free. And so if this is something that you want to see about doing for yourself with your specific guidelines and your specific sort of caveats for how you want the world to look, she takes us through it and explains it much better than I could explain it here. And it's there for you to watch.
Great. We have another question, and this is from Barbara, and she's wondering, she's got a large deferred compensation account and she's getting close to retirement, about 3 years away. Wondering at what point should she convert all or some of that into a Roth IRA? And so I don't know if you want to speak a little bit about Roth IRA conversions, or what should we be thinking about in general when we're getting close to retirement, and where our accounts should be located.
Yeah. So, Barbara, I would say now is a really good time for you to sit down with a financial advisor who has the tax software to look at account location and asset location, not asset allocation, but asset location, which, as Veronica was just saying, is an important component when it comes to which account do I draw from during a particular year. Roth assets are valuable because as you roll into retirement, when you pull money out of a traditional retirement account, whether it's an IRA or a 401k, you're going to have to pay income taxes at your current interest rate at the time. And those current interest rates may well go up if you're paying attention to our deficit. So a lot of people try to pay the taxes now rather than paying the taxes down the road because they are hedging their bets that paying the taxes at their current tax rate will be less expensive than paying the taxes down the road. That's where Roth conversions come in. If you have a year where you've got a lower income than most, if you've stepped out of the workforce, if there's been a layoff, if there have been certain things that have resulted in your income being lower, that can be a really great time to do a Roth conversion because you can do it at a lower tax rate. Figuring all of this out is the job of a financial advisor who can look at your entire picture and help you sort of strategize about what to do when. Because one of the things that you probably don't want to do is pull money out of retirement in order to pay the taxes on a Roth conversion. It's better if that money already comes from sources where you've previously paid the tax. But for any younger people who are watching, this is why you hear the Roth advice so often. When you're younger, your salary is typically lower than it will be when you're older. That means paying the taxes now on your retirement contributions rather than paying them after the money grows and grows and grows can be a really powerful thing to do.
We have a question from Timson. She's saying her mom is gearing up to retire, and you had mentioned equity in homes, and we've been encouraging her to move to a more tax-friendly state. Are there additional strategies that we should be considering, including renting versus owning during retirement?
It really depends on where she wants to live and how she wants to use that money. If she wants to, if you're encouraging her to move to a more tax-friendly state, are you looking at an apartment, a house, a CCRC, a continuing care retirement community where there will be lots of different kinds of living available. It's very, very dependent on her own situation and what she needs in order to both get into the kind of housing that she wants, but then also to sustain herself. If much of her wealth is concentrated in this house, then freeing it up, downsizing, and renting or buying something smaller may make sense. And you can just run the calculations on renting versus buying in the community where she's going to get a sense of how that will work because it's very, very regional.
You had mentioned financial advisors before, Jean. At what point do we know we need a financial advisor or a financial planner, would you say?
I think it's an interesting question because sometimes you need a financial advisor and sometimes you just need some financial advice. When you are looking for a relationship with somebody to manage your money on an ongoing basis, to do the investing for you, to meet with you a few times a year, to take this off your plate, then you need an ongoing relationship with a financial advisor. But if you are a DIYer, if you like doing all of this yourself and you just want somebody to look at your plan and see what you're doing, or if you're just trying to make a particular decision or two about how much you can spend on a house, or whether it's a smart move to borrow for college, or whether you should pay for college out of current cash flow if you have that capacity. That can mean a shorter term engagement with a financial advisor where you're essentially paying a fee just to get some advice. And you can do that because financial advisors have morphed. And there are advisors who work under the traditional assets under management model where they charge you a percentage of whatever it is you're giving them to manage. But there are also advisors who will just charge you a fee or charge by the hour or charge by the plan. And you can find them at different sorts of organizations. There's an organization excuse me, called the Garrett Planning Network, where they'll point you to advisors, fee-only advisors, but who will work by the hour. There's an organization called the XY Planning Network, where the models are a very different sort. There are monthly retainer fees, but there are also hourly plans and other different models available.
So many great things you've shared with us, so much amazing knowledge. And I know Angela is going to be coming on again to wrap us up. But before she does that, I would love for you to give us what are, say, three key takeaways from this event? If you could send us home with three nuggets, maybe we've covered or maybe we haven't covered that you advise us to consider, what would those be?
Um, number one, I would say follow the money. Follow your own money. I we go through life these days so quickly, and money moves more quickly than I've ever seen it move in my career with Zip, with clicks and swipes and dips and taps, and it's really, really hard to know what your money is doing for you unless you pay attention to it. So even if it's just for a couple of weeks or a month, take the time to look at where your money's going, because that gives you the power to make changes about where your money is going and gives you the ability to drive the bus. And it's how you free up additional money to invest, which is number two. If you are not investing for the long term, saving and investing 10 to 15% of whatever it is you make, you're not going to be able to sustain life in retirement. And so if you're not there, try to use what you learn in that budgeting lesson to start nudging your way there, knowing that you're going to make up some ground when you the next time you get a raise and the time you get a raise after that. And eventually you'll get to that 10 to 15% level. And then the last thing I would say, and it's very self-serving, but come check us out at hermoney.com. Come check out InvestingFixx. We'd love to see you there. We have a lot of fun. And I think this is, from everything that I've learned from you, Veronica, and from Angela, a like-minded group. So I hope that we can stay in each other's orbits.
I love it. Great. This is so, so great. Thank you so much, Jean. Angela, I'll let you take us away.
What a great, great event we had. What I loved is the simple talk from both Veronica and Jean, and so much to nibble on. And I mean, that whole investing fix sounds like a great idea. Jean, just at the investing fix, you talk about individual stocks, but do you also give some education about the different types of investments, like passive versus active and
Yep.
mutual funds versus, so all of that comes in too?
Yeah, the course is basically divided into two parts. So for the first part of each session, I do a bit of a personal finance lesson. So we might talk about ESG, or we might talk about target date funds or asset allocation, or other things like paying off your student loans, or how to get the basics of an estate plan, or how to pick guardians. And then Karen picks up the ball and presents two investments for our group to consider. And once a month, we vote on the investments. And one of the things that has been the most fun is that for members of our group who want to learn how to present stocks, do their own fundamental research, who have an idea for something that they think belongs in the portfolio, Karen will actually coach them so that they can make a presentation, and then our members get to vote on something that the members have teed up. And we've bought a couple of those, so that's been a lot of fun as well.
Well, for those of you who don't know Karen Finerman, she's still on Fast Money. Is that still a
She
show?
is.
She's a fantastic, for many years, she was the only woman with this bunch of guys, talked about hedge funds and stocks. I think I could see where it would be a lot of fun, Jean. So I want to thank everybody for joining us. Hope that you will fill out a survey, which you will be getting. This event will be available on our website, and I think perhaps Jean's somehow her social media, so you can listen to it or send it to your friends. So I really want to express thanks to both of you for all the time, and don't forget the preparation time. And one plug for our WISE website, we do have our past events, and Jean mentioned Social Security and the mistakes that people make. And there is a fabulous program that we have on Social Security there with Mary Beth Franklin, who's one of the experts in this whole area. So I urge you to take a look at that. But let's all sign up for, I get the newsletter. I love it. I'm looking at InvestingFixx. I think it sounds terrific. And a special thanks to our community sponsor, SheVest at UCI. And hope to see you next time. So thank you all for joining us. Big thank you.